The best mortgage rate strategy starts with controlling the payment, not predicting the market. Mortgage rates can move because of inflation expectations, bond demand, economic data, and lender capacity, so waiting for a perfect headline can turn a sound purchase into a guessing game. Set a maximum monthly housing cost that includes principal, interest, property taxes, homeowners insurance, mortgage insurance, and association dues. For example, a buyer approved for $500,000 may discover that the full payment strains the budget once taxes and insurance are included. That buyer might target $450,000, preserve emergency savings, and remain comfortable if repairs arrive during year one. A rate quote is useful only when the complete payment fits your life. Build the budget first, then let the rate, loan size, and purchase price compete inside that limit. Strengthen your borrower profile before you ask lenders for their best price. Lenders price risk, and the rate can improve when your credit score rises, revolving balances fall, income is documented cleanly, and DTI declines. Review all 3 credit reports early, dispute genuine errors, avoid new debt, and pay card balances before the lender refreshes your file. For example, a buyer with a $9,000 card balance and a $10,000 limit may look riskier than the same buyer, after reducing that balance to $2,000. Paying off a $450 monthly auto loan can also change qualification more than adding the same amount to a down payment, although cash reserves still matter. Do not close old accounts or move money unpredictably without asking your loan officer. A cleaner credit and debt profile gives every lender a better foundation for offering a competitive rate. Create competition by collecting multiple lender quotes on the same day. A mortgage quote is not comparable unless the loan type, term, property value, down payment, credit assumptions, points, and lock period are identical, because changing any variable can make a weak offer look attractive. Request a formal loan estimate when you are ready, then compare the interest rate, APR, lender charges, credits, cash to close, and projected payment. For example, a lender may advertise 6.25% but require $7,000 in points, while another offers 6.5% with a $2,000 credit. Put both offers beside another quote, then ask each lender whether it can improve its written terms. Keep applications within a concentrated shopping period to reduce the credit scoring impact. Real leverage comes from documented, same-day offers, not from asking a lender whether its rate sounds competitive. Judge the total borrowing cost, not the headline rate. The interest rate drives payment calculations, but APR blends the rate with many required finance charges, which can reveal when a low rate is being purchased with expensive fees. APR is still not a perfect decision tool, because it assumes a particular repayment schedule and may not capture every ownership cost. For example, on a $400,000 loan with a 30-year term, 6.25% might save about $65 per month compared with 5%, yet the lower rate could require $6,000 more upfront. Dividing $6,000 by $65 produces a break-even point of about 92 months. If you expect to refinance or move before then, the higher rate with lower costs may leave you wealthier. Compare APR, lender fees, monthly savings, and your likely holding period together. The best rate is the price structure that costs you least during the years you realistically expect to keep the loan. Treat discount points as an investment with a measurable payback period. A discount point generally costs 1% of the loan amount, but the rate reduction it buys changes with the market and the lender, so points should never be accepted automatically. Calculate the upfront cost, the monthly payment reduction, and the number of months required to recover the cost. For example, 1 point on a $400,000 loan costs $4,000. If that point reduces principal and interest by $60 per month, the simple break-even period is about 67 months. A buyer staying 10 years may benefit, while a buyer expecting a move or refinance in 3 years probably will not recover the expense. Also compare the value of keeping that $4,000 in emergency savings. Points are worthwhile only when the expected savings holding period, and cash reserves support the trade. Lock the rate with a written plan that matches the closing calendar. A lock protects your quoted rate for a defined period, but it can expire if appraisal, underwriting, repairs, or title work take longer than expected. Before locking, confirm the rate, points, lender credits, expiration date, extension fees, and whether a float-down option exists if market rates improve. For example, a purchase scheduled to close in 40 days should not rely on a 30-day lock simply because it looks cheaper. A 45 or 60-day lock may cost slightly more, yet it can prevent expensive extension charges or exposure to a late rate increase. If a float down is offered, ask what market movement triggers it and what fee applies. A lock is risk management, not a forecast. Match its length and terms to the actual transaction, so market volatility cannot derail an otherwise affordable purchase. Match the mortgage structure to how long you expect to own the home. A 30-year fixed-rate mortgage provides payment stability, while an adjustable-rate mortgage may offer a lower initial rate in exchange for future uncertainty. The lower starting rate matters only if your expected holding period ends before meaningful adjustments, or if your finances can safely absorb higher payments. For example, a buyer who expects a job transfer within 5 years might compare a loan fixed for the initial 7 years against a 30-year fixed loan. A buyer building a permanent home should place more value on long-term certainty. For any adjustable loan, review the initial fixed period, adjustment frequency, index, margin, and every rate cap. Stress, test the maximum plausible payment rather than assuming a refinance will be available. Choose the structure whose risks align with your timeline, income stability, and tolerance for payment changes. Optimize the down payment instead of assuming that more is always better. A larger down payment can reduce the loan balance, improve pricing, and sometimes remove mortgage insurance, but emptying your accounts can create a fragile homeownership plan. Ask lenders to quote several down payment levels using the same rate lock assumptions. For example, on a $500,000 home, 20% requires $100,000, while 15% requires $75,000. The extra $25,000 might eliminate mortgage insurance or improve the rate, but it might also be the cash needed for closing costs, repairs, moving, and 6 months of reserves. Compare the payment change and insurance cost with the value of liquidity. Pricing can shift at specific loan-to-value thresholds, so request actual figures at 10%, 15%, 20%, and 25%. The strongest down payment is the amount that lowers financing costs without leaving you vulnerable after closing. Use seller or builder concessions to attack financing costs, not just the purchase price. A modest price reduction spreads its benefit across decades, while an allowed closing credit can reduce the cash needed now, pay discount points, or fund a temporary buy-down under the loan rules. For example, on a 30-year mortgage near 6.5%, cutting the price by $10,000 may reduce principal and interest by only about $63 per month. A $10,000 credit could instead cover eligible closing costs and preserve cash reserves, or buy a permanent rate reduction if the break-even analysis works. A temporary buy-down can lower early payments, but the note rate still matters, and qualification usually uses that full rate. Concession limits depend on the loan program and down payment, and unused credit may be lost. Negotiate concessions with your lender and agent before finalizing the contract. Properly structured credits can create more immediate value than the same dollar reduction in price. Choose a mortgage that works today. Then define a disciplined exit strategy. Refinancing may lower a future payment, but it is never guaranteed because rates, income, credit, property value, and lending rules can all change. Accept the current loan only if its full payment is affordable without a future refinance. Then, monitor opportunities using a break-even calculation rather than a rate headline. For example, suppose a later refinance lowers the payment by $250 per month, but costs $5,000. The simple break-even period is 20 months, so the refinance makes sense only if you expect to keep the new loan longer and the savings exceed other costs. If you receive a large bonus, also ask whether the servicer permits a recast, which may lower the payment without replacing the rate. Build optionality into the plan, but make sure the original mortgage stands safely on its own. Bring these strategies together with a written decision sheet before you commit. Start with an affordable total payment, improve credit and DTI, collect same-day loan estimates, and compare rate, APR, points, credits, lock terms, and cash reserves. Then match the loan structure and down payment to your ownership timeline, and treat any future refinance as an option, not a rescue plan. Consider a buyer comparing 3 offers on a $400,000 loan. A slightly higher rate with lower fees may win for a 4-year stay, while paid points may win for a 12-year stay. The correct answer comes from the break-even math and the risks that buyer can actually carry. Mortgage strategy is not about finding a magical rate. It is about designing the lowest reasonable cost for your real life. If this helped you shop with confidence, like this video, subscribe to the channel, and comment with the strategy you plan to use.